demographics. Okay, that's the game. That's the whole game. Understand that, and you understand everything that comes after it. Then we've created this cyclicality. We had a perfect 4-year ISM cycle that changed, and it's driven the cyclicality of the economy, driven by the debt maturity distribution. So the debts have to be rolled, and we need to, because going back to this chart, if you remember, we pay it by debasing currency. And so when the debts get rolled, currency debasement increases. And that is the process by which markets and economies have operated since. It's all the same cycle, and it happens globally. So up until 2024, we had this perfect 4-year cycle. I mean, perfect. And that was because the debt maturity of the debts after 2008 was 4 years. And then something changed. And we're like, what the fuck is going on here? We didn't really understand it until we went back to this and redid the maths and realized in 2022. And
Bitcoin has exhibited recognizable patterns this year, mirroring corrections analogous to those observed from July 2024 to July 2025. These corrections, although they may generate frustration among investors, generally result in a rapid V-shaped recovery. This illustrates Bitcoin's historical patterns during correction phases, emphasizing that, despite brief declines, recovery is frequently observed. Currently, Bitcoin is trading near $84,500 after declining below the $85,000 support level amidst ongoing market volatility. Recent price movements indicate the persistence of a downward impulse wave, with analysts predicting additional declines that could potentially reach this significant support level prior to a rebound. Regarding market dynamics, the prevailing sentiment suggests a decrease in trading volume, with Bitcoin maintaining a relatively narrow trading range since early November. Despite this, Bitcoin continues to maintain robust support at approximately $110,000 levels, which have historically prompted reversals. Insights from financial analysts indicate that although short-term price fluctuations may appear disheartening, the overall technical indicators and market sentiment suggest the potential for a forthcoming rally. Furthermore, comparisons with prior cycles indicate that corrections of this scale are not uncommon in the cryptocurrency market, particularly for assets outside of Bitcoin's leading stratum. As the market continues to process these fluctuations, the future trajectory involves recognizing that these cycles are likely to recur, presenting opportunities for recovery as liquidity is restored and technical indicators strengthen. Insights from a recent discussion by Raoul Pal highlighted this viewpoint. Emphasizing Bitcoin's robustness throughout conventional market cycles and corrections, let us revisit Raoul Pal's most recent market update, in which he underscored that this is not the time to despair. Instead, it is an appropriate time to adopt a broader perspective, as these recognizable patterns frequently culminate in a surge that can surprise even experienced traders. To remain informed about the most recent financial and cryptocurrency developments, please like this video, subscribe to our channel, and activate post notifications. Thank you for your continued participation. Please enjoy the remainder of the video.
Offset it. That debt is financed by liquidity. This measure here is the Fed net liquidity, but actually in recent years, it's moved to US total liquidity and global liquidity for the global debt cycle. What's the difference between Fed net liquidity, global liquidity? Fed net liquidity is the Federal Reserve balance sheet plus the Treasury General account and the reverse repo that's now been drained and probably will never get rebuilt. But they've moved the liquidity onto the banks now, which is what our total liquidity measure takes into account, that plus M2 growth as well. Anyway, it doesn't really matter. Liquidity is the basis of money to pay the debt, driven by the demographics. Okay, that's the game. That's the whole game. Understand that, and you understand everything that comes after it. Then we've created this cyclicality. We had a perfect 4-year ISM cycle that changed, and it's driven the cyclicality of the economy, driven by the debt maturity distribution. So the debts have to be rolled, and we need to, because going back to this chart, if you remember, we pay it by debasing currency. And so when the debts get rolled, currency debasement increases. And that is That is the process by which markets and economies have operated since. It's all the same cycle, and it happens globally. So up until 2024, we had this perfect 4-year cycle. I mean, perfect. And that was because the debt maturity of the debts after 2008 was 4 years. And then something changed. And we're like, what the fuck is going on here? We didn't really understand it until we went back to this and redid the maths and realized in 2022 and 21, when rates went back to zero, they extended the maturity of the debt from 4 years to 5 years, or 5 and a bit years. And so what that did was break this. We had this extra year in the middle that we never had before. The extra year in the middle didn't need peak refinancing. The refinancing is for this coming 12 months. So we haven't had peak refinancing. So you didn't get peak economic growth. Economic growth was held because we didn't get that stimulus. Rates remained higher because of it. And the cycle extended to this. And this is the 5.4 year sine wave. Now, we don't know what the next cycle is going to be, depending where all the debt maturity ends up. They're all sticking it in the short end right now. It might shorten it back down to 4 years. Don't know. We'll have to see, but this is what we're dealing with. And where we should end up is peak cycle is somewhere towards the end of 2026. This is the reason we don't believe in the 4-year Bitcoin cycle that's suddenly independent of the NASDAQ. They're all the same cycle. Or the ISM, it's all the same cycle. But suddenly some people online, it's like, well, it's all over now. We didn't get our rally in November and October. It's finished, all over. Let's come back again in 18 months' time. Probabilistically speaking, that's a load of fucking wank. That probably gets me banned from YouTube. But wank's a great expression in England. Okay. So the game is paying the interest payments of the debt. That is where the debt growth is coming from, is the interest payments. Don't forget, the interest payments are now a larger part of the US budget deficit than the military is. And we do that by printing money. Dun, 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 dun. I mean, Christ, I've told you this a million times. So we print money and look, we've got lots of debt to roll and we need to print money to do it. Okay. And hey presto, gold has been following this like it knows. Yeah, because gold is real-time financial conditions right now. Financial conditions, the dollar, interest rates, and commodity prices. And gold is reflecting financial conditions, which is the forward look on liquidity. I'll come on to that in a sec. A bit confusing for you all, but gold is kind of explicable right now. Here's GMI global total liquidity versus gold. Gold says it should accelerate. Global total liquidity has been sort of, it got to new highs. It's flatlined a little bit because of what the US is doing. Meanwhile, China's increasing the use of its balance sheet, and the dollar's gone up a little bit. I think it probably rolls over at some point soon. We'll come on to that in a sec. And that then may lead to the final leg higher in gold and the final leg higher in markets. But you can see gold is basically pricing global liquidity impulse all the way to the end of 2026, which would be kind of what we're expecting for the cycle. Again, don't expect perfection. Raoul said, everything moves, deviates. You need to assess the probabilities, see the data as it comes in and understand. But when I put gold versus I don't know why Julian's put everything in pink. I don't know. He's feeling flamboyant. But what we've got is that's interest payments. Gold is forward pricing it. And following up is liquidity, which lags gold by 12 months. So we've actually got the phasing of all of this, these dominoes. We talk about these dominoes all the time. And why it matters to us is because it explains 90% of crypto's moves over time. Now, again, this is the issue with the impatience and the people who don't understand this stuff is like, well, liquidity's moved. Why hasn't Bitcoin moved? It's all broken. Everything's shit. It's like, no, it doesn't work like that. There is a variability around this stuff. This is a weekly plot chart going back 11 years. Not 11 years. It actually goes back, 12 years now. And you get variability around the mean. That's how markets work. That's the 10% difference in correlation. So you expect differences, and the differences give you informational value. But what you get is this stunningly high correlation over time. And again, people don't really understand this. They're like, oh, your charts, they're just correlation versus causation. They're bullshit. You're just inventing stuff. I'm like, no, and no. Okay. US government shutdown. This is where we got it wrong because it wasn't something we could know. And there's one bit we missed that we didn't really fully grok at the time. And that was the fact that once the reverse repo had been drained, which was a net stimulus, net liquidity boost, the rebuild of the Treasury General account, they build this bank account up and down. So it doesn't really matter. But when you've got no offset to it, and the Fed is doing QT, that was a 700 billion tightening in financial conditions since July. It was dramatic, and there's no offset. See, in 2023, when it happened, they were draining the reverse repo, and it offset it. But this one didn't have that. And so we didn't really see that. And that was what caused that global M2 chart that, like, people just don't understand, because I said it's not going to work all the time. But why didn't it start? Why did it break apart? Well, it broke apart very simply because liquidity got sucked out of the system.
The widespread assumption that the 4-year cycle influencing markets has ceased to exist overlooks the fundamental issue, which resides in comprehending the debt maturity profile. The primary determinant affecting markets is not the duration of the cycle, but rather the manner in which debt maturities are extended or managed. This financial reality influences market behavior more significantly than any cyclical theory. Analyzing market sentiment indicates a prevalent sense of frustration among investors. Many individuals find themselves trapped in unprofitable trades, eager for favorable returns, and confronted by bleak forecasts. These emotions frequently result in severe criticism directed at analysts, including allegations of inaccuracies or deception. Nevertheless, the message remains unequivocal. Market outcomes are not assured by optimistic timelines or trends. Rather, effective navigation necessitates adapting to debt-driven cycles and acknowledging that markets function independently of personal wishes or anticipations. Comprehending this elucidates the reasons behind recurring disappointments and highlights debt as the primary driver of market dynamics rather than arbitrary cycles or speculation. This perspective is essential in the context of ongoing discussions and evolving market conditions.
And it got sucked out of the most beta to liquidity asset in the world is crypto. So it came out of crypto. And if you think of the crypto beta curve, you got Bitcoin and then Solana, let's say, and then let's say SUI. They're all different levels of beta or leverage to this trade. And what happened is liquidity starts coming out over this period. Now, the TGA should have been started draining two months ago. And once they drain it, it starts lifting asset prices significantly, the normal cycle. What happened this time is they shut down the government. So they couldn't drain it. So it got stuck at $1 trillion. And normally you drain it, but they didn't. So normally we would have seen something like 2022 where we start to see a drain. We didn't get that because it got stuck because they stopped spending money. So therefore, no liquidity in the system. Therefore, stuff like M2 doesn't flow through the system and things fall apart. Now, NASDAQ didn't because 80% of all asset managers had underperformed the benchmarks this year because none of them had technology, and they still don't. There's still a record number who think AI is a bubble and therefore they're underexposed. So the more tech goes up, the more they have to buy into year end. And that dynamic's always very interesting. It's called performance or benchmark chasing. Added to the fact there's a load of buybacks in that sector as well. Very hard to fade. Very hard to fade unless liquidity is fully, totally turned and rates are going up and all that kind of stuff, which is not happening. The other thing is, if we think about the crypto market outside of Bitcoin, you'll notice that none of these things have gone to new highs, really. I mean, Ethereum, Solana, none of this has. Why? because it's driven by liquidity. US total liquidity has not gone to new highs yet, but it will over time because, again, to keep explaining this to you guys, because you don't want to hear me, and you lose patience, then you go, why didn't it go up? We've got to do this game. We've got to pay for the interest on the debt. The only way of doing it is global liquidity, or is total liquidity. And as you go through, that then lifts that. So if you go back to that chart, there's the hockey stick over time, that longer term version of the banana zone that has to come into play, because if not, the whole system falls apart. So there you go. Now, the last time it shut down was back in 2019. Again, we kind of broke the plumbing of the financial system back then. So good. We broke the plumbing back then. Once it reopened, so it shut down, the markets didn't like it for the same reasons. The plumbing started creaking. The Fed had to come in, start going back from QT to QE, and also injected liquidity. So here we are. The shutdown's ended. It takes a while before the money starts flowing. So the TGA's only just kind of released $40 billion, but we're expecting like $200 billion or $250 billion over the next 2 months. So what happens then is eerily similar, should stabilize coming few days, next week, today, who the hell knows, doesn't really matter. I know it feels like it does, but it doesn't. And then the market took off like a rocket ship. And all of this is to say that the reason we look at all of this stuff is Bitcoin is, and crypto is, a macro asset class. That's the important thing to understand. What it means by macro, it's driven by macroeconomics. And macroeconomics, for me, is the business cycle. And here is the business cycle, up and down. We talked about that before. And lo and behold,
Raoul Pal clarified that comprehending market movements is not complex. However, many individuals become distracted by short-term charts and unrealistic expectations. He stated that requesting returns from the market is ineffective, as the market simply does not respond to individual appeals. Referring to the ISM data, he observed that certain surveys, such as the Empire State Survey, are indicating significant increases associated with tariff adjustments, and the ISM Manufacturing Index is beginning to ascend, suggesting an improvement in business sentiment. Bitcoin, however, was valued as if the ISM were significantly low, at approximately 47, and diverged from these surveys, likely attributable to a liquidation event and the subsequent restoration of liquidity in the cryptocurrency market. He noted that October resembled a liquidation of positions, resulting in a tumultuous trading atmosphere. The dollar serves as a primary determinant of financial conditions, presently reflecting patterns observed during the previous Trump administration cycle. Pal anticipates that the dollar will maintain its upward trajectory in the short term before reversing, which is expected to result in alleviating financial conditions as liquidity is restored. Regarding technical indicators, he noted that Bitcoin's 14-day RSI was significantly oversold, indicating a possible rebound within the coming days or weeks. Volatility contraction, as indicated by weekly Bollinger Bands, has historically served as a precursor to substantial upward movements. Despite a recent 28% correction, Pal emphasized that corrections of this magnitude are customary in cryptocurrency cycles and conform to historical patterns. The Anxiety and Greed Index is currently at a very low level, indicating extreme market anxiety comparable to the levels observed in 2022. He highlighted that although corrections in cryptocurrencies, particularly beyond the leading tokens, can be significant, they are an inherent aspect of the volatility that investors tolerate in pursuit of potentially substantial returns. Pal contended that the overall market capitalizations, excluding Bitcoin and Ethereum, remain robust, disputing assertions that the cycle is defunct or that the 4-year cycle is merely an inviolable norm. He emphasized the significance of moving beyond simplistic narratives and employing a broader context to comprehend market behavior. In conclusion, given Bitcoin's recent price decline and market sentiment at extreme fear levels, what influence do you anticipate investor behavior will have on the next phase of the market? Kindly share your opinions in the comments section below. Please share this video and kindly click the like button. Thank you for your attention. Please remember to subscribe.